In February 2000, the yield curve inverted. 1 year and 1 month later, we saw a recession. In December 2005, it inverted again. Exactly 2 years later, we saw a recession. More recently, in July 2022, the yield curve inverted, and we have not seen a recession. Does this mean that we have avoided one? Or is the indicator that has predicted the past 8 of the last 8 recessions going to be right again? 2025 could get real spicy. We've got the Fed changing expectations with interest rates, certain stocks in the market at the priciest they have ever been, and of course the ticking time bomb of the dreaded yield curve. The definition of a recession is 2 negative quarters of GDP growth. So it's when the economy is producing less than the previous quarter, it's shrinking. A recession and a stock market crash are 2 different things. One is to do with the economy and the other is to do with the prices of businesses. In a recession, you lose your job. In a market crash, you lose your nest egg. These 2 have a unique relationship together. The one that has historically come first is the market crash. You've got the investors in the market. They can see that the economy is going to trend down, so they sell their stocks before the recession comes. The market goes down, a recession follows, and we tend to see a stock market recovery when the recession finishes or slightly after it finishes. Which brings us to the stock market today. Right now, we have very unique market conditions. This graph shows the S&P 500 growth stocks versus the value stocks as a percent of the market index. As you can see, growth stocks dominate right now and make up 70% of the market, where value stocks only make up 30%. So everyone is willing to pay high prices to own the likes of Nvidia and Palantir and Tesla, and stocks that are projected to grow a lot into the future. But the value stocks, they have been left behind. We have not seen a distribution like this in the past 30 years. Even in the 2000 dot-com bubble, the most extreme we saw was about a 63% growth stock distribution. And if you want to look up this information for yourself, just go to Yardeni Research. The Magnificent 7 stocks are the priciest of them all. Of course, we all know the Magnificent 7 are these 7 giant stocks. 12 years ago, these stocks averaged out only sold for a 2.5 price to sales ratio. Only 2 years ago, they sold for 4 times P to S ratio. Today, they sell for over 7.5 times. They have tripled in price relative to the amount of sales that they are making. Why? Because everyone wants to own them. They're all over the news, the index funds love them, and investors believe they will grow. The only problem is, often in a stock market bubble, it's the growth stocks that do the best while the bubble is growing. But when the bubble pops, growth stocks get absolutely hammered, and the value stocks are the ones that hold their ground. In the dot-com bubble, Pets.com did really well, but when the bubble popped, the Pets.com stock collapsed. From 1995 to March 2000, Cisco systems had gone up 4,000%. But when the bubble collapsed, Cisco was the last stock you wanted to own. It collapsed, it went down almost 90%. The investors who bought when the price was high were the ones that were left in tears. Historically, there are times when it's a really bad idea to be a growth investor, and of course, that's when there's a market bubble and prices are sky high. The Federal Reserve is the group that controls money in America. I know, that's a big job. Because they control the money in America, as an investor or just anyone, it might be a smart idea to look at what they're doing. Are they making money easy and cheap by lowering interest rates? Are they pumping dollars into the system? Or are they making money hard to get by increasing interest rates? Originally in 2025, they had this plan where they were going to cut interest rates 4 times. This would mean that interest rates would drop by a full percentage point and everyone's happy because money is cheaper. You can borrow for cheaper amounts, your mortgage payments are lower, businesses' debts are easier to service, and obviously this is good for the economy and the stock markets. That was the Federal Reserve's plan, but something changed. Have a look at America's inflation rate. What do you see? From 2015 to 2021, we had that period where inflation was like Goldilocks' small bowl of porridge. It was just perfect. Not too hot, not too cold for the Federal Reserve. Remember that their goal is to have inflation at 2%, And over that period, it was pretty much right there throughout those 6 years, and Jerome Powell could sleep happy at night. 2021 comes by, country gets shut down, businesses are struggling, and Powell knows he has to warm up his money printer, and of course what happens? Inflation takes off. Some say it had to be done, but then Powell realizes he has to control inflation, so he brings interest rates up, restricts monetary policy, and inflation starts to simmer. The problem is that it's not simmering as low as Jerome Powell wants it to. The Fed's goal is 2% inflation, but right now it's hovering around 2.6 to 2.7%. Or in other words, inflation has been sticking to a higher level than the target.
But inflation seems to be stickier, and I think the Fed's coming around to that conclusion.
Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal.
So why does any of this matter? You're wasting my time, Cooper. Well, the problem with inflation being higher than the target is that we may need to keep interest rates higher for longer to lower the inflation. This means businesses will have to pay more on their debt. Corporations can borrow less money. Individuals' interest payments on their house stay higher than what it has been in the past. And overall, this is not a great thing for the economy.
The Federal Reserve is in trouble. They were supposed to cut interest rates 4 times next year in 2025. So that was their official projection written in their SEP. Now, because inflation is coming in hotter than expected, it's worse than what they thought. They're now saying that their official projection is 2 interest rate cuts next year instead of 4.
We've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still, going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. As we go forward, we're going to want to be seeing further progress on bringing inflation down.
So, less rate cuts than what they originally projected. Does this mean that we should panic and sell stocks because the economy is going to crumble? Maybe if you're Jim Cramer, but no, of course not. It simply means the economic environment may not be as rosy as everyone originally expected it to be. It may still do well, but just not as well as it could have with the increased interest rate cuts. Volatile conditions like these are a good reminder of why many experts suggest diversification is key for a good portfolio. Not just diversification among stocks, but a portfolio with a mix of asset classes is going to provide even more protection against volatility for a slice of your portfolio. JP Morgan Asset Management just talked about this in their 2025 outlook, saying, the traditional stock bond framework of 60-40 may be reformed into one that also includes alternative assets. A 50-30-20 portfolio, for example, with the 20% allocation to alternatives. Interesting, right? Now, a 2022 report from Citi, in collaboration with Masterworks, details an alternative asset class that actually has a negative correlation to developed market equities, i.e. stocks, since 1995. Citi is actually talking about blue chip contemporary art, which sounds like an obscure asset class until you consider the billionaires who sit on 9-figure plus art collections like Microsoft's co-founder Paul Allen. While JP Morgan didn't cite contemporary art specifically in their reports, other studies like a 2023 one by Deloitte estimate the overall art and collectibles wealth at nearly 2.2 trillion and projected to hit 2.9 trillion in 2026, leaving lots of room for potential upside. That is why I think you should check out today's sponsor, Masterworks, while you're still early to the scene. Their art investing platform has already distributed back a total of over $60 million, including principal, in investor proceeds across their 23 exits. And you don't need to be an art expert to be involved. You also don't need to throw down millions of dollars and can diversify between multiple artworks. Because Masterworks art investing platform features blue chip artwork offerings to investors in the form of shares. Some of Masterworks' previous offerings include legendary artists like Picasso, Basquiat, and Banksy. And they're over $1 billion of invested capital, so popular offerings have the potential to sell out rather quickly. So if you're interested in learning more and want priority access, you can use the QR code on the screen now, or click the link in the description, or go to masterworks.art/Cooper Academy. Now back to the video. Before the start of the year, Wall Street gives their estimates on where they predict the stock market will go. In 2024, stocks went up 27%. In 2023, stocks went up 24%. So what are the quote-unquote professionals saying will happen in 2025?
I think that there's a lot more tailwinds building for markets in 2025 than have existed in 2024. We have an election that's behind us, and now we have a lot of cash on the sidelines, and I think companies finally having more courage and what I think we'd call animal spirits and a willingness to start to do mergers and other things like capital markets that actually help stocks next year.
Citi, JP Morgan, and Goldman Sachs predict that the S&P 500 for 2025 will increase to 6,500 points. Barclays says 6,600 points. Bank of America, 6,666. Deutsche Bank, Yardeni Research, and Wells Fargo predict 7,000 points, and Oppenheimer predicts 7,100 points. If we aggregate all of those year-end forecasts, the median has the S&P 500 hitting a level of 6,678 by the end of 2025. So that's about an increase from today's price of 10%. The interesting thing about all of these forecasts is that these same companies made projections for what the S&P would be for 2024, and basically all of them got it wrong. But they didn't get it wrong as they usually did by over-projecting. In these two cases, they underprojected. The S&P 500 actually went to 6,000 points in 2024. JP Morgan predicted that it would be 4,200. Morgan Stanley projected 4,500. Bank of America 5,000. Goldman Sachs 5,100. And Citi 5,100 too. So they were off by like 1,000, 2,000 points. And in the past 4 of the last 5 years, analysts have underestimated the index, which kind of tells a story of just how high prices are right now. But then you look all the way back over the past 20 years, and analysts have overestimated the index more often than not. So it just shows you that these predictions are actually not that accurate, and it's not a sweet science as, you know, some of the Wall Street analysts may expect it to be. No one can project the market in the short term, but when it comes to predicting the economy, there is one indicator which has historically been quite reliable. The yield curve has predicted every recession since 1969. That's 8 recessions from the past 8. That's 50 years of 100% accuracy. Just remember that the inversion predicts a recession. It does not predict a stock market crash. Although they are related, these are two completely different phenomena. So what is the yield curve and why does it hold such importance? The yield curve plots the return on government bonds against their time to maturity, ranging from short term to long term. Normally, you would expect a higher yield on a longer term bond because investors are giving their money away for an extended period of time. Thus, logically, they would demand a higher return. But there are periods where this is not the case, where investors are willing to accept a lower yield on a long-term bond compared to the shorter-term one. In these periods, investors are seeking safety because they're concerned of poor economic conditions to come, so they don't mind locking their money away at a relatively low rate. If we look at what's happening right now, we have just come out of a yield curve inversion. If you look back to 1980, it's the period after we come out of the inversion when the recession hits. Normally, this can take about half a year to a year before the economic downturn. I just want to be clear, by outlaying this data, I am not coming out and saying that I am predicting a recession in 2025. All I'm doing is giving you the figures, and then it's up to you on the conclusions that you make from the data. If we take it from the point of time when the yield curve inverts, not after it's come out of the inversion, on average, a recession occurs about a year after that point. But this period can vary. Historically, it has ranged from a short lead time of just half a year to a long lead time of nearly 2 years. The yield curve inverted in July 2022, which means it has been about a year and a half so far, which could result in the first half of 2025, things can get spicy. It comes down to two things. Either the predictor that has historically been very accurate is going to be right again and we see a recession in 2025, or this time it's different and the recession does not come. Which, I mean, theoretically could happen. There have been occasions where the predictor has not been accurate. That was quite well deep into the past, but these occasions have been few and far between.